Hello traders, Gary Wagner here, just about 1 o'clock in Honolulu, 6 o'clock in New York. It is Friday. Happy Aloha Friday, as we say on the islands. It is the 28th day of February, 2020, and this is the weekend review for the gold forecast. As one of our presidents once put it, this is a day, or a week in this case, that will live in infamy. I doubt that many professional traders, investors, analysts, and market participants will forget the kind of carnage we saw in U.S. equities and, for that matter, in gold. Gold down tremendously today in double digits, about $55 drawdown, and we've seen the same thing all week. In other words, we've seen U.S. equities under pressure, and rather than the safe haven asset gold catching those investment dollars, that has also been selling off. On today's opening letter, I provide what I believe to be the best explanation, and it's based on the only other occurrence that I have witnessed in which both classes sold off this difficultly, and that is during the 2008 recession. We saw stocks come under pressure. We saw gold go from 1,000 back down to 700, a 30% retracement before both of them moved up in tandem. However, there's a major distinct difference between what happened then and now. That was a financial crisis solvable by financial tools, central bank intervention. This is an epidemic that could possibly, and I underscore the word possibly, turn into a pandemic. Traders, in terms of the overall carnage this week, even with today's sell-off of 357 points in the Dow, about 1% and 0.4, we have seen incredible carnage throughout the week. Considering this is Friday, this green candle down here, Thursday, Wednesday, Tuesday, and Monday, what we can see first of all is this tremendous gap between the close of the market on Friday and the reopening on Monday. That's right here. Then what we saw the following day is a break below the 100-day moving average. That's the first time we've seen that for a while, and that was followed midweek by the first break below the 200-day moving average, and that, of course, occurred on Tuesday. Then on Wednesday, the market actually opened below the 200-day, closed below the 200-day. This is Thursday's activity, yet another gap. And today, we made the lowest low that we have seen in quite some time. It's the largest sell-off in 1 week, I believe. But we did recover near the close. It is a hammer-type candlestick, but it is not enough to give us any kind of technical indication that the selling is over. Nonetheless, this has been one of the most severe sell-offs in U.S. history in terms of the equities markets, but gold didn't really fare much better because it has been under pressure all week. And traders, in my 35 years of trading experience, I've only witnessed this occurrence on a couple of occasions. One that sticks in mind is 2008, when we saw a meltdown in the financial equities markets and gold at the same time. Interestingly enough, a mass sell-off in silver, almost 6%, but that was not the percentage leader in terms of drawdowns. We'll get to that in a second. But we have silver that's under pressure below $17, $16.68, a dollar drawdown, and closing just below the 0.618% retracement level. The big loser today, obviously, palladium. What goes up really hard comes down really hard, losing $211 at $2,500. Lastly, platinum suffered a 4.3% decline. It is trading at $866. The 13% decline we saw in the Dow Jones Industrial Average was matched by a drawdown in Bitcoin even. Now, Bitcoin only gave up $210 today at $87.35, but it began the week 13% above this price point. And that was all with dollar weakness, providing some tailwinds and curtailing what could have been a worse drop. Let's take a look at our technical studies. It has been quite some time since I have seen the kind of drop that we saw this week and especially today in gold. Take a look at this single long candlestick. It is a tremendous sell-off. Gold giving up $55 at $1587.30. It's broken through critical levels. We'll go through that in a second. But first, what is most important to me is the low today, because as you can see, it still matches up with the 50-day moving average. Now, that doesn't mean that it won't go lower next week, but what it means is that it tentatively found support at that critical short-term average that is used so aggressively by other technical traders. But let's take a look at the areas and price points that we did see gold break through. So traders, we're looking at a chart that we have been using throughout the last couple of weeks to define certain key areas. These numbers right here are based on an extension. It is a Fibonacci extension of this rally right here, going from approximately, call it a 1250 up to 1565. But traders, even more impressive is when we add the 78% retracement level, which is the correct Fibonacci retracement level, you can see that that was the high of the week in terms of a close right here. Now, it obviously broke through that. The next level that was important to us came in at approximately 1631, and that was the 0.618% retracement. We have a 50% retracement at 1596. I said that I believe that 1600 should hold. That was absolutely an incorrect assumption because we saw it run through here like a hot knife through butter, and it did not stop its drop until it hit this 50-day moving average. So what are we looking at? We do have a potential area of real support here at about 1560. If it cannot hold that area, and that's a critical area, we'd be looking at 1540 and 1520. Those are the past two tops. But I think we've got to wait this weekend out. We will have a great opportunity in terms of a buy here, but it is certainly not occurring this week. Remain neutral with no active trades. This has been Gary Wagner, wishing you as always good trading. We will talk to you on Monday for the next daily update and review. Bye-bye.